If your portfolio has been riding the waves of recent market swings, you're probably looking for a way to anchor your capital against the volatility. Enter China Yangtze Power Company, or CYPC. By market capitalization, it is the largest hydropower operator on Earth. CYPC controls a continuous corridor of 6 cascade dams along the Yangtze River. Combined, this physical infrastructure generates over 307 billion kilowatt-hours of electricity a year. But buying into this scale comes with a strict trade-off. You are completely sacrificing explosive upside in exchange for heavy, defensive stability. To understand if it fits your strategy, you have to stop looking at CYPC as a traditional equity. It functions much more like a high-yield, inflation-protected infrastructure bond. If you check the current S&P Capital IQ data, 18 analysts rate CYPC as a strong buy, projecting roughly an 18% upside. The table shows why analysts like the stock. Left, the broader market has high beta and erratic dividends. Right, CYPC backs its capacity with a locked 70% payout. A 0.04 beta means almost zero correlation to market swings. When tech crashes, this line stays flat. However, a buy rating in the utility sector depends entirely on what your portfolio actually needs to accomplish. You have to ask yourself if locking your capital into millions of tons of concrete is the right strategic move for your personal timeline, or a slow-moving trap for your money. The operational engine driving CYPC is its Six-Dam coordinated dispatch system on a single river. By controlling the exact flow of water through massive gates at facilities like the Yangtze Dam, they optimize power generation across the entire chain. This creates a highly efficient buffer. In the first half of 2026, when upstream dams struggled with low water levels, the downstream Three Gorges facility compensated by surging its output by 31%. Yet, that exact same data exposes the company's absolute vulnerability: weather reliance. Upstream facilities experienced significant water inflow declines early this year. The Wudongde Dam alone recorded a 16.76% drop in generation. Let's map this risk on a quadrant chart, comparing market correlation against yield predictability. The H1 2026 upstream decline adds a data point that pulls CYPC's predictability score slightly down. As an investor, you are trading standard macroeconomic risk for meteorological risk. A drought in the Yangtze Basin impacts the entire revenue chain. To offset weather risk, CYPC guarantees a minimum 70% dividend payout through 2030. Back on our chart, this locked payout adds a data point pushing CYPC to the top of the yield predictability axis, creating an income stream yielding roughly 3.5 to 3.7%. The opportunity cost of extracting 70% of your cash is a severe lack of high-growth reinvestment. Analysts expect earnings per share to grow at a meager 2.6% annually. Despite slow growth, there is a hidden short-term profit driver. The massive turbines installed in 2007 and 2008 have finally completed their 18-year depreciation cycle. This accounting milestone artificially boosts current net profit. It wipes roughly 1.2 billion RMB in financial expenses off the books for 2026. Eventually, these physical assets will age out. CYPC is already bidding out massive capital upgrades, like the renovation of the Gezhuba control system. Dropping accounting costs make current cash flows look stellar right now, but inevitable future maintenance will force the company to take on new debt and re-leverage its balance sheet. The final variable to weigh is ownership. Recently, China Three Gorges Corporation completed a massive 4.5 billion RMB share buyback. This state-level backing provides a robust price floor on the Shanghai Stock Exchange, signaling ultimate institutional confidence from the controlling sponsor. The trade-off is concentration. Following the buyback, insiders and concert parties now control 53.23% of the total shares. This creates structural exposure to government mandates. If the state decides to lower electricity pricing to stimulate the broader economy, CYPC must comply. Buying CYPC means accepting that, as a minority retail shareholder, you have virtually zero voting leverage over corporate direction or state compliance. This decision tree splits your goals into 3 paths. The income path secures 70. Ultimately, CYPC is a globally unique physical asset that functions as a massive defensive shield, not a sword. To make it work in your portfolio, you just need to align expectations with its reality.